Perfect.
Hi, everybody. This is David Skrika, stock chart of the day and addicted to profits. Right today, I have Brett Heath of Metalla Royalty. So, Brett and I have not talked in a long time. I think he got on this kind of marketing package I do back in 2017, 2018. And then when the gold market was still dead, I just decided with some of these companies, why don't I just wait a few years till we do interviews again? And and then, he's actually now residing in Puerto Rico. I live in the Bahamas. I've been in the Bahamas a long time, but we haven't really talked. I think the last time we talked was before COVID, and you guys were really just kind of piecing together the company and putting together a lot of the royalty plays that you have now. I actually think you could correct me if I'm wrong, but in 2018, you guys weren't listed on the AMEX too. I think you were just still a Vancouver listing.
That's correct. So we started the company back in 2016, and back then we were actually a CSE listed. This was kind of back when the CSE there wasn't a ton of companies on there.
Yeah, I'm gonna get the
And
chart just so you like a 10-year chart, just
uh,
so we can see well, it's 2018 because that's when you moved to Vancouver. But yeah, I,
yeah,
I remember the
so
2016.
yeah, so we started there, and we started building our business. As you're aware, and I'll probably just kind of do a quick recap just because it has been so long. But we really took a long-term approach on our business, and we focused on the highest quality assets. This means the best operators in the business. This means the best jurisdictions in the business for making investments, and then it also means the best geology, the most proven geological trends around the world. And where we saw the most value was on the development side of the business. So this was kind of anywhere between kind of right before production, maybe kind of back like 5, 6 years prior to production. And what we noticed was that those last kind of 5, 6 years, as the majors or mid-tiers advanced their pipeline projects into production, they spent a lot of capital and they invested a lot of capital into these assets. And so there was a very significant growth curve. And so, we came together and said, look, we're gonna have this strategy. We're gonna go after this type of asset. And in order to be able to buy these assets, obviously the Agnicos and the Barricks and the Newmonts at the time, they don't sell royalties to any company, not even the biggest royalty companies for any size dollar amount. So that kind of put us into this place of buying existing royalties. So these royalties that were created sometime before, whether it was a corporate divesting the asset, took a royalty back, or a prospector, or a private equity fund, or basically everything under the sun. And we kind of built a platform. And with this platform, we had a very efficient and effective process, not only to find these really great assets, but then to execute on them. And if you go back from 2016 till today, then you have about 32 different transactions that we've executed on, over which we've acquired 102 royalties now. So now we've got a very, very significant portfolio of assets that kind of stem from Canada to the US, Mexico, and then really the better parts of South America and Australia. And so, yeah, 102 assets. We've deployed a little over 300, about 309 million approximately US dollars, buying these different assets. And and fast forward till today. So fast forward till today, you're about 8 years into this business. We just had our kind of our 8 year anniversary here just come up in September of this year. So just about a month and a half ago. And all of these assets that we bought that were in development are now basically right on the forefront of production. And
And
so,
so,
yeah.
if you can just explain to say people that are newer to gold mining industry, Um, why did you decide to say become a royalty company rather than just like a pure, a regular miner that produced its own assets? Like there are certain benefits like I could get into. Like if you look at the companies like Franco-Nevada, Royal Gold, the Sandstorm, the larger guys, they usually have a big premium compared to regular companies. They have much smaller, amount of employees, so less overhead. Obviously because you're well diversified, if one mine has a problem with it, it's not going to kill the company. So if you could just maybe those are my kind of arguments for why I like royalty plays. And you talked about all the costs associated with getting a mine into production. As a royalty play, you're kind of just investing in the mine, so you're not totally involved with all those costs, especially the cost overruns. So but if you can just discuss yourself like what appealed to that segment of the market rather than just say being a quote unquote like producer.
Yeah, that this is a really important part about understanding this business. And originally, I came from the buy side, and we made a lot of investment in the mining companies across the world. And um, with the royalty business, see the way the royalties are structured is it allows you to take an asset allocation approach, but it allows you to really have time on your side and be able to leverage the optionality piece of this business, which I believe is so misunderstood
Yep.
today. And what I mean by that is royalties are non-dilutive. So when you buy your 1 or 2 or 3%, let's say XYZ mining company has this property or this project, and they have to raise $500 million, $1 billion to build this project. Well, what are they going to do? They're going to take on some debt. They're going to issue some equity, maybe some converts. Basically, what that means is if you own a piece of this asset, you're going to get diluted down significantly by the time this thing goes in production.
Yeah, yeah.
Now, if we go in there and buy that royalty, and let's say we buy that royalty at a bit earlier stage before kind of the deposit is fully understood by the operator. Well, we not only get the benefit of having a percentage of what's in the ground on a non-dilutive basis, but it's free carry into perpetuity. So this is a really interesting, or I would probably say incredible kind of structure for owning assets, because you can go in and you can really kind of understand what that optionality is, and you can price that very attractively. And if you've got a little bit of time, if you've got shareholders that have a long-term view, this can work out very, very well, because you buy that 1-2% at an early stage or earlier stage of that asset. You see that asset grow, going from 1 to 2 to 3 million ounces, kind of as it moves towards production. Then the mining company has to spend $500 million building it. That's all free carried for the royalty holder. Finally, the asset goes in production, and you get top line cash flow. So it doesn't matter what the costs are. Obviously, we focus on assets with big operators and great geology. So typically our costs are in the lower half, if not the lower quartile of costs from a cost perspective of the asset. We feel like that's a way that we can manage risk as well. But that being said, it's still top line cash flow, and that goes into perpetuity. So even 10 years down the road, if let's say the mining company spends all this capital, they've got a 10-year reserve life. 10 years up, they've got another 10 years of reserve, which often happens on really good assets. Again, all of that is free carried. And 10 years from now, you get 10 years of cash flow, and you get another 10 years, don't have to pay for anything. So when you understand kind of how that works, and then you can kind of take an asset allocation approach like we did, and about 102 of these royalties that are being advanced by some of the biggest mining companies in the world. It kind of, once you can get that critical mass, that portfolio, which is where we are today, things get really exciting.
Yeah, and like I said, what I agree with is like that kind of exponential expansion of your potential revenues based on kind of a fixed investment, right? Because if you get the combination, like you said, of that resource expanding plus the underlying value of what the asset you're selling, e.g., gold and silver, going higher in price, then yeah, that little 1% you bought for this fixed amount could be worth, 5 to 10x what you originally bought it for interest once the revenue and cash flows are beginning. And that's why you see, like, if I can throw up, because we're gonna look at the Metalla stock chart in a second here. Let's look at it in a second. We'll look at now, then I'll throw up another chart.
Mhm.
I was telling you off screen, like this is what's called, like Metalla is what I would call like trapped in a or was trapped in a box, and now is kind of breaking out. Or there's another saying we use. These are just little slogans, like the longer the base, the more the space. So you can see Metalla basically had been basing for the last year and now is breaking out. And if you look at it this way, again, gold and silver prices are much higher now than they were in 2023, and you guys are still 20 to 30% lower in price. So to me, the stock, is essentially still cheap, So as well. So um
Yeah,
uh
and these portfolios have a tremendous amount of leverage. And I hear a lot that the mining companies, investors go to the mining companies because they have more leverage. And that's true. And but it's only true usually for a period of time. Because what historically has happened is as the gold price goes up, the gold price is typically signaling inflation to come in the future.
yeah.
And so what you see is you see the gold price come up, the margins expand on the operators. So they're making very, very healthy margins. But over the next year, sometimes two, I mean, there was so much inflation at COVID, it only lasted like a quarter or two. But basically, costs go up with it. And so, eventually they end up with kind of that same margin that they did prior. But the royalty companies, it's, every single increase in the underlying metal price, it's straight to the bottom line in regards to the cash flow that the royalty company generates. And so when you look at our portfolio today, to our account covers about kind of 1.6, 1.7 million gold equivalent ounces. So significant amount of gold equivalent ounces. And so that means that every, call it $100 increase in the gold price and every 50-cent increase in the copper price, it just that increase generates about a $50 million increase in US dollar increase in our existing NAV. So there's a lot of leverage that's there, and a lot of that leverage is already baked into the value of this business. And the analyst community is slow to take up that gold price. So right now, you've got kind of long-term gold price around kind of $2,100 gold. And so, I mean, you've got $600 of gold. As these analysts will slowly start to walk it up. I mean, we're expecting some significant increases through the end of the year. And into kind of Q1 if gold holds in these levels. But there is a lot of leverage here for investors, that's for sure.
Yeah, and like so what I wanted to move on to here just to show you because like some of the the longer term like I'm just gonna show Franco Nevada here in terms of like again I'm being a technical guy kind of the okay this is just but if we get a really long-term chart like 25 years you can see okay well let's get the Toronto chart because it's only been listed in New York for you can see going back 20 years Franco Nevada has gone from $10 to almost $200, and we're talking gold in that same time frame went from 700 or 800 at its lows in 2008 to, to 20, just gold's tripled and this is up almost 20x and like a Royal Gold is kind of similar, Royal going from a few, So I'm just trying to show that when these royalty companies can be run, strongly, and you like you're talking about, you get that leverage and the cash flow. This is what they can do. Like they can really outperform the price of the metal. And remember, since 2011, gold equities, even though gold is 2,700, have done pretty miserably. I think the HUI is still 30 to 40% below its highs. And you can see Royal Gold and these royalty companies are right near their highs.
Yeah, and we're to be fair, Metalla is still
Small.
pretty far away from our previous highs, and I think we've got a lot of room to run here. But what we've seen, I mean, what we've witnessed since the beginning of the year is gold is in the most stealth bull market that I've ever witnessed in any sector, any commodity, or any industry. And obviously, like we can talk about all the different reasons. but they don't really matter.
Yeah.
The truth is that gold is in an incredibly strong uptrend, and the underlying equities that in really good solid businesses that show or kind of maintain the value or are supposed to maintain leverage to the underlying gold price have not come in, have not participated in that rally, and there is a very, very significant kind of catch up. But really what it comes down to is the flows. Like there just hasn't been the general fund flows. I'm looking at the VanEck GDXJ, which is the largest junior gold ETF right now, on my screen, and I'm looking at the fund flows. So this isn't the performance of GDXJ. You look at the performance, it's looking pretty good, but that performance is in the face of, over the last 6 months, the GDXJ has had a little over $300 million of outflows. So guys coming in, investors selling this GDX as it's going up. So it just kind of goes to show, I do think we may have seen a change. We've definitely seen a change in the ETFs. So since the beginning of 2022, there's been 2 quarters of gold inflows, and this last quarter was one.
Well, one thing
And
point I've
yeah.
made is I believe, and I think it will reverse itself at some point, that the fund flows, these ETFs actually hurt the gold and silver equities in the last 20 years. And what reason I say this is that if you kind of, this is my warning to crypto investors with the Bitcoin ETF, is that when these ETFs came in, we all thought this is great. They're going to get in huge inflows, and then in turn have to buy the entire sector, and this will create all this buying. But I think the exact opposite happened in that the ETFs were weak hands, just people that trade or those people that weren't really long-term holders in gold. Like I think the people that owned gold equities 20 years ago, and they owned Barrick and Newmont, Franco-Nevada, et cetera, they were the real hardcore, I guess, gold bugs, or I guess the hodlers or whatever you want to call it, of the mining industry. And then when you had these big downturns in the market in the last 10, 15 years, those ETFs in turn, like you're talking about, sold, and actually you
Mhm.
got a lot of outflows in the industry. And I think the ETFs actually exasperated that situation. Now, I think that will reverse, and then they'll at some point see inflows and then have to buy all these equities. And it's a small sector, gold and silver and precious metals. But what I'm trying to say is, I believe in the short to intermediate term, meaning the last 5, 10 years, the ETFs actually hurt what you're talking about. The price action in the equities, made them lag because, like you said, there's outflows, and obviously the world has changed a lot from 2009 in that Bitcoin didn't even exist back then. We've had booms in AI and all these different tech sectors as well, EVs, all this kind of thing. And I think my opinion is, you're talking about the macro side. What we need to see some kind of shakeout, and the regular markets, the stock markets, the Dow, S&P, et cetera. And then when the Fed has to, get even more aggressively cutting rates and stimulus and quantitative easing or whatever, a lot of that will come into the gold and silver market. You saw that like in 2009 to 2011. And even in 2020, you saw that like gold and the gold, silver, and the precious metal equities were some of the first stocks breaking out right after that smash during COVID when all that stimulus started. So that's my opinion. I don't know if you would agree with that, but I would just say number one, I do think these ETFs short term hurt because they brought in investors which were not like long term holders, and
Mhm.
and then number two, I think that a shakeout in the equity market, while the gold and silver shares would probably get hit short term, that ultimately will lead, trickle down to them starting to lead the next move higher.
Yeah. Well, I mean, look, I do agree that it has had some influence there, in regards to kind of pulling some of the direct investment out of the different mining businesses. But the underlying point that I think is important to pay attention to is that, we've seen gold go from 2000 to 2700 with basically almost no participation, not even no participation, but we've had net negative participation um, over that same period of time by the West.
Well, and again,
So
I put up
yeah.
the GDXJ, and again, I know it's rallied from its lows back in, the February, March. But what I'm trying to show here is that, you're talking about gold. The high was what, 2,000, 2,100 back in 2020, and the
Mm,
GDXJ is roughly 10% below that level, even though gold is 35% above that level. You know.
yeah.
So I'm just trying to. I 100% agree with you. Like, you just haven't seen the inflows and the price action. But I think at some point that will kind of turn around. But it's interesting to see. And I think, and you would know this better than me. I think one thing that's going to help now as well is as we kind of wrap up here is this last move in gold and silver has kind of happened with limited inflationary pressures after COVID, as you know, the price of food, the price of energy, everything, housing, operating costs, everything went up. And, so that $2,000 gold price, say in 2022, was not the same as a $2,000 gold price, of 2011, or 1900 or whatever the high was then. And I think now, though, we've got the prices moving higher and, oil's at 70, the food costs are starting to flatline. So I think I'm expecting to see really good cash flow from these companies generated this quarter and the fourth quarter.
Yeah, I think we'll see record on the cash flow, on the margins for the industry in the third and fourth quarter. That's going to drive, I think, some more investors and some more flows into these equities. Um, and I mean, look, it's just you go back and look at some of the investments that we made 3, 4, 5 years ago, and these assets are now just starting to come in production. But some of these assets were 4 or 5 year paybacks when we made the investment. Now they're 2, 3.
Well,
So
and I have your press release from this morning, which shows some of the updates and some of these, like the Gosselin and the Endeavor and the whatnot. So I don't know if you want to quickly talk about a couple of these for a few minutes before we end, or just I can also post the link to this underneath this video so people can see the updates.
I can talk about a couple of them that I think are important to pay attention to. So the recent drill results out by IM Gold on Gosselin were very significant because basically what it's showing is that, look, these two deposits connect. And when you look at our royalty, the 1.35%, it covers all of Gosselin, kind of a small piece of Cote on the north side of the pit, and then pretty much everything in between is where they're drilling today. And seeing that there is that potential for these assets to connect, that kind of shows or tells me that, look, this is going to be, or it at least has potential to be a super pit kind of detour malarctic type of asset. And getting royalties on these types of assets not only are obviously very valuable, but they elevate your entire business, your entire portfolio, and they continue just to go. They continue to go. You look at some of these great royalties that are out there and some of the majors, they've been able to kind of leverage their entire business off these things. And so we think we have one with Gosselin. It's in the making. It's, I think, not even remotely close to priced appropriately within our portfolio. But I think that over the next 6, 12 months, as that starts to finally be a focus of IM Gold. IM Gold was solely focused on basically building Cote and getting it in production. That's now complete. So Cote is ramping up. It'll be running at a commercial rate in the early part of 2025. And really the focus kind of going forward is going to be how do they daylight the value at Gosselin. We bought the royalty on Gosselin pre-resource. So again, kind of going back to that strategy, we knew there was a very, very significant deposit there. We didn't know the extent of it. The operator didn't even understand the full extent of it. It was still early days. But fast forward a few years, now that the Gosselin deposit's already 7.4 million ounces of gold.
Wow.
We think it'll easily get through 10 million ounces, probably somewhere between 8 and 10 on the next resource update, which will come out in the first half of next year, most likely.
And
And
I'm
we'll,
sorry, I don't know much about that project, so I don't interrupt. But how much production are they looking at doing a year there from it?
they're looking at doing 500,000 ounces a year. It's
Okay.
basically from an ounces perspective in Canada, it's going to be the third largest gold mine in Canada. We think there's potential for them to look at this kind of super pit scenario, which would require them to probably scale up the throughput to about 55,000 tons per day. That'd probably lift production modestly, even a little bit higher. So, I mean, that's probably out a handful of years. But, again, very, very compelling royalty that we were able to pick up.
Okay, and we've got about
Right.
5 minutes left, so can you do one more and then we'll wrap it up? Like one more
Yeah,
project.
so one more on the kind of the near-term cash flow that's going to make we think, a pretty material difference is our 4% royalty on the Endeavour mine. This is in Australia. It's a restart. It's produced for us in the past. They just put out an updated mine plan back in August. It looks very, very good. They've had very good drill results, and most importantly, they just fully financed it back in production. They brought in a good offtake partner to put up the capital to restart that asset. They reiterated guidance for the first half of 2025. So for 2025, if they can execute and bring production on by the first half, that probably means about 1,000 gold equivalent ounces to Metalla's account in 25, and then probably 2,500 to 3,000 gold equivalent ounces just from Endeavour in 26 and 27 and 28. And just to kind of put that in perspective, the five or six assets that we have in production today for 2024, guidance was around 2,500 to 3,500 ounces. I think we'll probably end up kind of near the middle range of that for this year. But we've got this asset coming on. Tocantinzinho is another one that's basically started already. We'll get our first check this quarter. Same with La Guitarra, which we noted in here, and Amalgamated Kirkland in Q4. So the profile of this business is going to look completely different within the next quarter. And I think that's what you see in the share price. You see it breaking out on really solid volume. And we've got a very nice stair-step in growth, running kind of between a high 30, low 40% CAGR in free cash from these assets coming online between now and 2027, kind of every single year. And what that leads you into is kind of 2028 to 30, where we think our gold equivalent production will end up being somewhere between 20 and 30,000 gold equivalent ounces. That's, approximately about 10 times what we're guiding to today. So, and these are going to be driven by very, very significant assets. Taca Taca, one of the largest copper development assets. Castle Mountain, will be a top 10 gold mine in the United States once it's built by Equinox. Kind of, these are ones that are a little bit further out. But basically, you've got this really great stair step that goes into this very significant jump, kind of right as you get into the latter part of this decade. And we believe that this growth lines up extremely well for this bull market that we're in. Because when you look at it, like things are just kicking off. Like there isn't even there. I mean,
No,
there's basically,
this is the
no
first or
froth in any
second
of
inning of the breakout. Yeah,
Yeah. So when you think about it from that perspective, if you remember, like when gold broke out in like 99, 2000, like it made a very, very significant run through 2000. And then also, gold has these moves. And so when you look at our portfolio, you look at kind of the growth, you look at what that growth is kind of underpinned by the high quality operators and the really solid, safe jurisdictions. And most importantly, the proven geology, because I wouldn't be surprised if 10 years from now, even if we bought nothing and we took all of that cash flow, all of that gold equivalent production in, I would be very, very surprised if our kind of consolidated reserves and resources to our account is not higher than where it is today without spending a dime. So that's the beauty of the royalty business. And, when you can position yourself over the long term on really great royalty businesses, again, that have these long-term views, which is what we've done since the very beginning, and you're patient, these things can yield some great returns. I think that's where we're at today.
Okay, well, thanks for joining us. And yeah, I have to upgrade my damn my Zoom account. I just got a new credit card. But anyhow, but thanks for joining us, and we'll do this in a few months. Like we get another
Okay,
update. Thank you. Thank you.
appreciate it, Dave.
Okay,
Thanks for
okay.
having me on.
Thanks. Bye.
Okay, bye.